So GameStop down 80% in a week. Is this just the beginning of a wild ride? And if so, where does it end?
Yeah, I don't know. I mean, my literal answer would be I don't know. And this is one of the most fascinating things that's played out as the internet, intersects with finance. And a lot of people have highlighted, or they believe that it's similar to social media's impact on elections and politics, right? And one of the most fascinating things is the groups of people it's brought together to seemingly stand behind one side or another. And so, I think AOC and Ted Cruz ended up, rooting for the same player here in this battle between the small investor and the giant hedge funds. What's super interesting is real damage was done to the big hedge funds. Like they took, big write-downs in a market that's been, predominantly hot. And so that's interesting. I think the other super interesting thing is it's uncovered that people have been talking about there's a problem in the plumbing. I think there are lots and lots of problems in the plumbing that fester for years and create the dynamics that allow something like this to happen. The key question.
So let's talk about let's talk about the problems in the plumbing and start with Robinhood. I know you've said their business model is based on a bizarre reality. Where do you think Robinhood is getting it wrong?
Well, their whole business model from the very beginning was to tell the user that something was free, and then to make money somewhere else. That somewhere else in this case is what's known as payment for order flow. And so the practice of payment for order flow is illegal in 4 other developed countries: UK, Canada, India, and Australia, and for a reason. It creates massive, enormous conflicts of interest. And what happens is when you put an order into Robinhood, they don't put it on the exchange, either the NASDAQ or the NYSE. They sell that order to 6 different companies that they work with who are really their customers. That's who pays them revenue. The largest being Citadel, but Virtu, there's several, and all that's disclosed. You can find it on Twitter, on the internet. And those people are even, in addition to kind of maybe, choosing the bid ask they want to fill it at, they're allowed to front run the trade in their own account. And I think it's misleading to the user to say something's free when you're probably those companies aren't paying for that order flow for no reason, right? Why you have to ask, why are they paying for it? Well, they're monetizing it. And that has to do with giving you bad execution or front running your trade, which has the market moving away from you. And you imagine you get a whole bunch of people buying out of the money call options, and then you get the broker that's clearing those trades front running them, and you're going to create massive volatility like we saw.
So in that case, what should Robinhood do differently, or what should the SEC be doing about this?
Well, there are many arguments as to why you should ban payment for order flow and have people directly connected where you'd have more liquidity in the right place anyway. I was able to find a letter that Citadel, ironically, had sent to the SEC in 2004, where they did as good a job as any. They listed 5 detailed bullet points on the conflict of interest that come up and why payment for order flow should be banned. And I would encourage people to read that. The UK government also did a whole bunch of studies before they banned it in 2012, and they've studied it since and think they're in a way better place. So that's one. The second thing nobody's talking about, and there's really 3 things, but the second thing nobody's talking about is there are 3 different dimensions where Robinhood takes more risk than their competitors. 1 is use of margin. 2 is encouragement of option activity. So the option trades relative to normal trades much higher there. And then 3, they let you trade before cash settles in your account. They kind of forward you money. All 3 of those things directly affect the variables that go into the capital requirement commitment that they were forced to put up. But nowhere along the way did they say, oh, well, here's the calculation for that requirement, and here's why these actions that we take as a business are directly implicated there. And meanwhile, those same things attract customers. So they have that problem in that they made themselves more interesting to people for those reasons, but it means more risk. And that's why the clearinghouse, came down upon them. The third thing I was going to mention, we can wrap this up, but, it's now known that 64% of their revenue comes from options trading. And so the company wants you to believe and goes on public television and claims that their mission is to democratize investing. And I would say, if this is mostly options trading, that's, there's no book from Warren Buffett or Peter Lynch or any, Burton McHale, who's a famous, that says, hey, the way to invest for the long term is to trade options. No one's saying that. They would all dispute that. And so what Robinhood's really doing, I think, is kind of glorifying speculation. They're not democratizing investing.
So do you see a fundamental shift happening in market power from institutions to individuals? And if so, how should the strategy of professional investors be changing now that there are new rules? You always say play the game that's on the field, and it seems like the rules have changed.
Well, some of it will depend. I think that the new SEC commissioner is paying attention, and Congress is paying attention. So we'll see, whether things change that might eliminate some of the plumbing issues that might cause a future attempt like this to not work as well. They may also come up with regulation around not voicing that you like a stock or don't like a stock, but if you are intentionally giving instructions to people on how to manipulate liquidity in a stock, they may come down on that. And then the third thing that no one's asking is how much staying power does the Robinhood base really have? You just mentioned on the open $18 billion of market cap's gone. The hedge funds were cleared out by the time that happened. So who was left holding that bag? And how burned are they? So the next push may not have as many soldiers left if there's lots of broken soldiers everywhere.
A lot of people lost a lot of money. I do want to get to, you've been a longtime proponent of direct listings, and we've seen a number of high-profile IPOs over the last couple of months. Airbnb, DoorDash, Affirm, Poshmark doubling or more than doubling on opening day. I spoke to the CEOs of all of those companies on opening day. They're excited. Nobody said we got the price wrong. But what do you think? Do you see something wrong with that picture?
Oh, absolutely. I think all those companies could theoretically be held accountable for violating fiduciary duty. Selling the most valuable asset you own at half the market price, knowingly doing that, is it's ignorance. I don't think you will ever ask someone on the day of their IPO, did you just make a massive mistake, and have them say yes. So the reason I smiled when you brought that up, there's zero chance that's going to happen. So I'd probably tell you.
Is it the company though, or is it the bankers?
Well, the problem is, and I have some data right here, first day underpricing in 2016, 2 billion, 17, 4 billion, 18, 7 billion, 19, 9 billion, last year, 30 billion. So the problem's getting ginormously worse. And then yesterday, on the Hong Kong exchange, Kuaishou, $5 billion deal, $9 billion underpricing on one deal. Look, the modern day best practice that the banks advise is they tell you want to be 30x oversubscribed. Now, I think we could go back 400 years and find economists that would tell you how supply and demand affect price. And no one No one in 400 years of economics would suggest that the best practice would be to have a 30x supply-demand imbalance. Yet, every CEO, every CFO, every board member that talks to a bank in the 2 weeks going into their IPO, they're told that's what they're supposed to do. And they listen to that and say, oh, okay, that's great. It's plain stupidity. The great news is Commissioner Clayton, on his way out the door, approved, and just amazing for me, at least, approved adding capital to a direct listing. And I fundamentally believe that, 5-10 years from now, no one will adhere to this idiotic practice of giving away billions of dollars in a single day.
Wow. You never mince words, Bill, and that's why we love having you here. I do want to get to Amazon because you were the lead analyst on Amazon going back to the 90s. You posted a nostalgic tweet of a photo of you and Jeff Bezos from back in the day. Andy Jassy is incredibly well respected, but I wonder what risks do you think Amazon faces without Jeff Bezos at the helm? And is he really going to be able to hand over the reins and lean back, or is he going to be the backseat driver?
Yeah, I mean, I'll raise a provocative question that you might ask, an Amazon executive, but it is my belief that Jeff, clearly the best strategic thinker I've ever met around business strategy, but he has another superpower, which is he's able to take those ideas and systematize them. He's able to implement them in a company that now has over 1 million employees, and those practices are able to scale. And that's been what he's amazing at, right? Like, it's not just that he has the idea for AWS, it's that he can scale it so much. And so I think the optimist would say, he hasn't struggled to take his genius and push it through the org and have the org absorb those best practices. And so, so there's plenty of parts of Amazon where Jeff's not touching, the day-to-day details. No human could. And so from that perspective, I would remain, quite optimistic. I also think that in both of these huge businesses, they have remarkable strategic advantages at this point, probably higher even in the classic consumer business that they have.
So you think you're not worried about the regulatory issues?
I'm not. I mean, I think there's a lot more heat on other companies than on them on that front.
Okay.
It's
All right, Bill,
I have a very cynical view
Final
on regulation.
Final thought. We got to go, but I'll give you a final thought.
I have a very cynical view on regulation, and I have some interesting studies from Goldman and Morgan I've found to back it up, which is, regulation's the friend of the incumbent. Most of the time when Washington, D.C. leans into a new industry, you lock in the incumbents, and the rules are written by the incumbents and make it very hard for new entrants to come up behind them. So I would say the more regulation, actually, the more you want to own the stock.